Mortgage interest rates significantly rise this week, all in preparation from any bombshell that Jerome Powell was going to make in a speech at Jackson Hole, Wyoming this week. Let's go ahead and dive into all that information and see what happened right after this. Welcome back after the break, everybody. Mike Petras here, your star realtor of Star and the Treasure Valley, back with another episode to where we're going to go ahead and cover what happened in the mortgage interest rates this week between the dates of August 22nd through the 26th. Now, as I did mention in the intro, really mortgage rates went up significantly this week in order to really prepare themselves more or less for any kind of a bombshell that Jerome Powell, our Fed chair, was going to make at his speech today at Jackson Hole, Wyoming. Now, was his speech kind of relatively scripted and straightforward with what we generally kind of already know and what should be happening in order to tackle inflation? Yes. So let's go ahead. Let's dive into that information. Let's see what he said. Let's see how some of the markets reacted and maybe what we can anticipate coming up here in the future. So let's go ahead and let's dive into the data here, and we'll go ahead and we'll start off with the unified mortgage-backed securities for the 30-year. We can see that the coupon shifted officially over back from a 4.0 to a 4.5 in this. But really what I kind of want to point out is it's generally been a rough week when it comes to the interest rates for your home. And a lot of the reason, again, and I'll reiterate one more time, is that everybody was really kind of anticipating maybe a potential bombshell that was coming down from the Fed relating to this and relating to the bond market overall and the overall state of our economy, and then what they have to do in order to continue to make inflation come down a particular direction. But if we're looking down, scrolling all the way down here, to the UMBS 30-year for the 4.5, we could see that, we took some hits. We took a hit on Monday. We took a hit on Tuesday. We took a hit on Wednesday, went up. We got some relief that came back our way yesterday. But then according today too as well, we're also still starting to see some hit within that. And I'll get to that and explain as to why here in just a bit. Well, let's go ahead and let's take a look at the 15-year UMBS. We can see it's gone down 0.13 basis points here today. And again, the same trend that we had. We took some hits as they were preparing for a bombshell, especially in the bond market. Because what we do know and what we'll see here in a little bit is that the mortgage-backed securities or the interest rates on your home loan really kind of follows the yield rate of what's happening in the 10-year Treasury note. Or the 10-year Treasury bond, sorry. But if we take a look at the 4.5, again, on Monday for the 15-year, it took a hit. Interest rates went up. Same thing again on Tuesday, but got some relief there Wednesday and Thursday. And again, today we're taking another hit to where the interest rates are going to go up. And again, remember, when the value of the mortgage-backed security goes down, you can expect the rates to go up. And when the value of the mortgage-backed security goes up, we can expect the rates to come down. And we're seeing here, boom, we've went down again today. And then if we're looking back at the 30-year, we have also gone down today as well. Okay, where do the interest rates land today? If we are taking a look at a 30-year fixed loan, we're looking at 5.73 according to Mortgage News Daily. For the day, we're down, of course, 0.08%. But for the week overall, again, we took a pretty brutal week. We were up overall 0.13%. And over the month, we've seen an increase of 0.18%. If we're looking at the 15-year fixed, we're sitting at 5.10%, down today 0.03%. But over the week, again, up almost a quarter point, so up 0.20%. And over the month, we're definitely over a 0.25% at 0.32%. The 30-year FHA is sitting at 5.12%, which is down 0.13% today, and over the week up 0.12%. 30-year jumbo sitting at 4.92, down 0.03% today, and up 0.07% over the week. 5-and-1 ARM is sitting at 5.93%, which is up 0.02%, and then up 0.06% over the week. And our 30-year VA loan is sitting at 5.15, down 0.10% today, but over the week up 0.10 overall. So not only did Jerome Powell speak today in Jackson Hole, Wyoming, to talk about what the Fed's basic plans, kind of dropping hints here and there of what they're planning on doing in September went down, but also the PCE report, or the Personal Consumption Expenditures Price Index, which is like the CPI, but it's really the Fed's baby of what they look at. And they've been looking at that since 2012 more generally than the Consumer Price Index or the inflation rate overall. But what we have seen from what they've been doing with the federal funds rate and increasing it, okay, on Americans in order to slow this inflation rate may finally start being to show some signs of promise. If we're taking a look at the year-over-year rise in just the PCE, it only rose 6.3% in July, which was down from 6.8 in June. So we're starting to see that. And actually the month over month in that same index actually fell 0.1% month over month. So that's good news. It's showing some good signs that the Fed's response is starting to show something to be able to combat inflation that's going on. But again, that is just a very, very preliminary thing. We have to monitor this as it goes along, and we'll get to that here in a few. But then there's also the core PCE index, which doesn't include things like food and energy prices. Again, that had a rise of 4.6 year over year in the month of July, and only a gain of 0.1% month over month, which if we kind of scroll down here, and we're looking into that, the actual PCE, the core PCE, which doesn't include the food and the energy prices, showed that 4.6% rise, but it was down from last month in June, which was at 4.8. So again, we're showing some signs that the Fed is actually doing what it takes to be able to kind of combat the inflation here. But during his speech, which I went ahead and watched, and of course, just for the sake of this video, I'm not going to go ahead and include it. But his speech, again, I felt was kind of like scripted, kind of kept going forward. He did kind of touch upon a little bit, on the confidence that he's got, but again, still saying that they are determined to still move forward and make this happen in order to bring inflation back down to 2%, which is where they want to have it. He says that it's going to take some time. So again, he's saying this isn't going to happen overnight, etc. And he's kind of bleeding it out, I think, a little bit more or less to protect himself from being scrutinized. But he says that we can anticipate a softening to the labor market happen. And when he's saying that, basically is he's trying to say again, through everything that he was talking about, that they plan on raising the federal funds rate again in order to be able to combat inflation. So he said that it can happen an unusual rise again in the federal funds rate. Now, you got some people talking about, well, considering this data, are they going to go ahead and they going to just go up maybe like 0.5% in the federal funds rate, or will they go up another 0.75%? Well, my guess is on the track that they're at and how he went from being transitory early in all this, or having the transitory mindset, he's turning around and being a lot more aggressive. So I can actually probably see a 0.75 point rise, and we'll talk about how that's going to affect the bond market. But he did say that's going to soften the labor markets, and it's going to hurt us and businesses as this continues to go up. So that's something we need to pay attention to. But he still said that the federal funds rate through 2023, they still anticipate it to be below 4%. But honestly, we're just going to have to wait and see on that one, and see if what they're doing currently, and as they increase the federal funds rate in the meeting in September, whether or not that's going to continue to bring down inflation. So Powell said, and the PCE, okay, is showing signs of effective inflation control. But Powell, again, I want to say, said that the job isn't done and expects the FFR to continue to rise, the federal funds rate. The other thing that I wanted to point out here real quick, and let's go ahead and let's shift over to this particular article, is again, the federal funds rate and overall inflation is on a global scale. So it is other countries too that also affect us. And one of the things that we take a look at here is the European Central Bank rate hike. So they came out today, and the European Central Bank said, well, in order to combat our inflation, we have to go up by 75 basis points. Is the America going to follow that suit? Now, some of these other countries and their inflation is getting hit harder than us, but I would anticipate that Powell will raise it up by another 0.75 in the meeting in July, which is just, it's going to put more pressure on us as we go. So now, how does the increase in the federal funds rate really kind of more or less hurt the bond market, which correlates over to the mortgage-backed securities that really control our interest rates? Well, if we take a look at this particular article from Investopedia, it's basically saying that falling interest rates make bond prices rise, and then the bond yields will fall. And of course, as we know, as the bond yields start to fall, the mortgage-backed securities or the mortgage interest rates generally follow those really closely. So as they continue to rise the rates, however, the bond prices are going to continue to fall and the bond yield is going to rise. And when that rises up, we can expect the interest rates to go up with it. So considering what is going on with what Powell was talking about and basically his overall stance, do we expect the federal funds rate to go up again in their next meeting in September? Yes. So what is going to happen? Now, we don't know where it's going to land. It's going to be a 0.5 point, 3/4 point. I'm thinking more or less a 3/4 point, but we'll just have to wait and see. But as those interest rates, as the federal funds rate goes up, we can see that the bond price will fall and those bond yields will rise. And as the bond yields rise, we can expect our interest rates to go up with it. Let's take a look at the 10-year Treasury today. The 10-year Treasury overall, it opened up at 3.035 for the actual yield, and we're sitting at 3.03, so it has come down a little bit, but we can see that the price change though on the bond has lowered. So bond prices going down, we can expect it to kind of go up. And guess what happened in the mortgage-backed securities today? The value went down and the interest rates went up. If we take a look at the 2-year Treasury yield, and I want to focus on another thing here momentarily, but the 2-year Treasury yield opened up today at 3.376, and today, or right now, it's at 3.382. So the yield is up, the price has gone down over here on the actual bond. So you can see the correlation happening. And again, interest rates are on the rise. Now, one of the things that I did mention in my Wednesday video, and please go back, talking about, are we in a buyer's market, where I sat down and talked with Matt Pfeiffer of Axial Home Loans, is we talked about the 2-year Treasury yield compared to the 10-year Treasury yield. And normally, the longer you put in your investment into these bonds, the more of a yield you're generally going to get. And right now, the 2-year Treasury yield is still outpacing the 10-year Treasury yield. So what does that mean? It means that the Fed still has to come in and put the brakes on the 2-year Treasury yield to get our slope still back in the right direction. Because right now, the 2-year Treasury yield is still above. So we can still kind of see an overall inversion in the yields. So if you have any further questions about this, feel free to reach out to me. But the key point we need to take away here from his meeting today is that really the overall yield kind of more or less flatlined itself today. So his speech didn't really have, a huge impact yet, but we're going to have to wait and see. And as more data comes in, what the Fed is going to do in their September meeting in order to try and continue to combat inflation. But we can expect things to get worse before they're going to go ahead and get better. Well, thank you very much, everybody, for taking the time out of your day to watch this video. I do hope that you found all the information useful and that you can start seeing, the puzzle kind of come together in terms of how monetary policy is really kind of affecting everything generally overall as it goes into the bond markets and then filters its way into mortgage-backed securities, which controls our interest rates. So again, weekly, I will be doing this, but keep in mind too, buyers, you marry the home, but you don't date the rate. So if you come out here and you buy, even with interest rates the way that they are, and still in the fives, is relatively historically low considering. But considering that there is inventory out there, you can really kind of get the home of your dreams. And then as this filters itself out, the recession finally generally hits, and all this data filters itself out, we can expect those rates to come back down and you can go ahead and refinance. So right now, buyers, this is still a great time to head out because you could really get the home of your dreams without really the fight, and you can get a lot of things going for you, like the price reductions that are currently happening right now. And then on top of that, this is a buyer's market, so now we can start talking about concessions and moving those over. So really, right now, buyers, you do have the power. And again, you marry the home, which you could really marry a home instead of having to try and fight for it like you did a year and a half ago, and then just date the rate. And when things come down, refinance, generally for free. Well, if you have any further questions or you're looking to buy, sell, and invest right here in the Treasure Valley, please feel free to reach out to me. I can be reached at 208-715-STAR. Again, that's 208-715-7827. And if you're looking to begin your home shopping experience today, please visit my website at www.yourstarrealtor.com. Also, don't forget to hit or go into the description below if you're thinking about moving in from out of state. Download my free relocation guide so that way you're in the know before you decide to make the move. And also, please feel free to comment below and also hit that subscribe button, click the notification bell so that you're constantly in tune with all the videos that I do come out with. Well, thanks again very much, everybody. I look forward to the day that we speak. I look forward to calling you my neighbor. God bless. Until then, thank you so much. Bye-bye.